Nike shares are down 60% from their all time high, and investors have to be wondering, is this a value stock or a value trap? Is this the kind of dip we should be buying? Well, a lot has changed in Nike's business and competition has come in more than ever. But let's dig through exactly what's happened internally at Nike. And the biggest thing over the past couple of years is that sales are declining. This is not a good sign for a retail company that should be able to increase prices and increase volumes. But Nike eschewed a lot of its wholesale partners during the pandemic, deciding to go directly to consumers, and that has resulted in the declining sales that you can see here. And the worst thing about this is that it has also coincided with declining gross margins and declining operating margins. Those operating margins in the single digits are lower than they were both during the financial crisis and during the 2020 pandemic. But the problems with Nike could be more strategic. I mentioned earlier, Nike basically pushed away a lot of its wholesale partners. That's where most of its volume went through. And what Nike would do is they would build up a big brand that people would recognize when you would walk into a retailer. You would recognize shoes from LeBron James or Michael Jordan. That identification increased the conversion when you walked into the store, whether you were buying a pair of shoes or a shirt or another sports item. But when Nike decided to go direct to consumer, it left shelf space for a lot of up and coming companies. Companies like Hoka and On. These are brands that have been growing in place of Nike while building their wholesale business from nothing. So even a small loss of market share for Nike can be a massive gain for companies like that. The margin pressure is partially coming because Nike is now trying to go more direct to consumers, and that comes with spending on social media advertising with companies like Meta Platforms or Google or TikTok. Nike can reach customers directly through those platforms, but they're going to be charged for that targeting. And what retail companies have come to find out is that those tech companies are very good at extracting margin to reach those customers. So that's why your profitability is declining, despite the fact that Nike has a better direct-to-consumer business today than it's ever had. The brand landscape has also changed. In the 1980s and 1990s, when Nike was growing like crazy, it could have brand endorsements from a number of high-profile athletes, spend millions of dollars on those, and then translate that into phenomenal growth and a very high ROI on those endorsement deals. But now in a world of direct advertisements, that isn't quite as effective. Name recognition for athletes is not as important as it was in the monoculture of the 1980s and 1990s. In its place is more niche businesses. If you're a runner, you want to be with the absolute best running company. If you're a golfer, you want to go with the best golf company, not just the biggest brand. And those two sports are examples of areas where Nike has tried to grow, but has not gotten the foothold that it has in an area like basketball. So competition is coming in partially because they can operate in a completely different environment. They can build their brand differently. They don't need to have the big brand sponsorship deals. They don't need to have big advertising campaigns. And that's just not a world that Nike grew up in. There isn't one winner in sports anymore. There are lots of winners, and some of those winners are the ones taking shelf space from Nike at retailers today. There's also a valuation problem at Nike. Now, the valuation at Nike could be an opportunity or a threat depending on how you look at their business. The price to sales multiple of 2.3 is lower than it's been historically for Nike's shares, but that's because sales are in decline. A price to earnings multiple in the mid to high 30s also could be an opportunity if they're able to increase those operating margins and get that profitability back up and turn around revenue. But that's where you have the potential for a value trap. What we've seen at Nike is that sales are going in the wrong direction. The margins are going in the wrong direction. And unless that changes, even at the lower price that we have today, the significant drop in shares over the past few years, Nike stock looks like a value trap. So where are there better opportunities? I think there are opportunities for growing companies like On Holding and like Deckers Outdoor, who owns Hoka. Both of these companies are growing extremely quickly. They trade for a slight premium to Nike's shares, but that premium is well worth it given their growth trajectory. On top of that, you get much better operating margins from both companies that you get from Nike. So the upside is significant, especially when you look at the opportunity to grow into the space that's been left by Nike and other big brands. So is Nike stock a buy here today? I don't think so. I think this continues to be a value trap, and the future of athletics is going to be these smaller, more niche brands that are playing in the high end of the market and are able to have higher growth, higher operating profits, and are trading for only a slight premium in the market. For investors, risk reward matters, and Nike is much higher risk than a lot of people think. Now, let us know what you think about Nike and the other brand opportunities in the space. Leave your comments in the comments section below. Don't forget to check out fool.com/invest for our top 10 stocks to buy right now. Thanks for watching, everybody. We'll see you here next time.